Hey, how's it going, everybody? Welcome back to the channel. And today we're going to go over a extremely simple investing strategy that might be useful to your buy and hold. So what we're going to look at is the S&P 500 index, also known as the SPX. I'm using this one instead of the SPY just because it gives me a lot more data. Electronically traded funds didn't come out until the mid 90s. So by using the SPX, we're going to get a better data set to look at. And what this investing kind of buy and hold strategy consists of is simply buying the S&P 500 when the RSI goes oversold and then leaves that oversold. So if you're not familiar with the RSI, the default RSI setting has a 30 level as the oversold. So once price goes, or once the oscillator goes below that 30 level and then goes back above 30, that's when we do our simple buy. So we're going to start at 1970 and we're just going to mark up everywhere where it's going to go out of that oversold level. So starting here January of 70, so we get this oversold level, we register at 27, and then the next week we are at a 32, so we're just going to do a vertical. And then from here we're going to check the 6 month, the 1 year, the 5 year, and the 10 year return. So here's our first one here. Just to make everything simple, we'll grab from the top. And then this one happened in February, so we're gonna add 6 months to that. So February 2 plus 6 is 8, so let's go to August. And more or less, so our 6 month return, let's say we're down 11%. And date of purchase is 2-70. And we have 11. And this whole percentage real quick. Okay, now let's go check out our 1 year return. February. So as you can see, now we're up 11%. Let's go to the 5 year return. 70. 5. Down 8. And finally, let's do the 10 year return. So February is 80. And like I said, this is extremely simple. And while we're doing this, just know this does not account for dividend adjustments. So over time, this will actually be a better percentage. So let's say that's 35%. Okay, so as you can see here, just off the bat, the average kind of buy and hold is right around 3 years for most investors, but if you're actually doing buy and hold, you should be looking more to that 5 to 10 year horizon, if not longer. So off the bat, not a horrible purchase. We were down for a considerable amount of time, but over the long term, that 10 year return, we did still see a pretty decent increase. So let's go to our next one. So moving back here, our next oversold was on May of 70, so we'll go ahead and mark that once we get out of there. Alright, so we're taking it from the top, let's do the 6 month. So 5 plus 6 is 11, so November. 70. So that's 12%. And bear with me, this might be a long video, but I think it'll be pretty beneficial if you just kind of just to see what all these different scenarios are. Now let's look at the 1 year return. So May 71, that's 36%. Let's look at the 5 year. So SMA is 75. That's 19. And then let's look at the 10-year. All right, so even a little bit better than our last one. Let's go back here. So, and finally we got another one right there. So this one is kind of clustered. You know, if you had to do all your buys, let's say you bought $1,000 every time it goes oversold and it comes out of oversold. So just in 70 alone, you would have already put up $3,000, which might be a lot for some people, might be nothing for other people. So as many of you know, the stock market is fractal. So if you need to add a zero, add a zero. If you need to subtract a zero, subtract a zero. You know, it's kind of whatever your budget can afford. But this is just kind of an easy way to, you know, baseline everything. If you bought $1,000 worth of SPY every time that this strategy went and signal the buy signal, that's kind of what we're looking for here. So let's do June. So that's 6. Let's go to December 15. So let's see, so it's 16%, 6-month return. And then let's do our 1-year return. Let's call it 30%. And then let's do our 5-year return. Let's call that 19%. And then finally the 10-year return. Right around 50%. All right, so just off the bat, you can see the 1-year return has been pretty great on these, a 30%, a 36%, and 11%. So just buying this straight off the bat and selling 1 year later, you're going to be doing at least as good as the S&P's, you know, kind of annual average return, which is right around 9%. So in this case, the 11% outperforms, and then the 36% and the 30% stiffly outperforms. So just on this basis, the strategy is already kind of, you know, working a lot better just than, you know, buying on January 1st and holding for that next year. So moving back, so then we don't get any oversolds for a while. You know, we get kind of close here in 73. So then in 74, we finally get one. So August 5th, 74. So let's go ahead and mark that. Let's check our 1 year or our 6-month return. So August is 8 plus 4 is 12 plus 2 is February. So February. So 6 month, let's say that's a negative 1%. So right there, 74. Now let's look at our 1 year return. That's called 6%. 5-year return. 79. August. That's 28%. And then let's look at the 10-year return. That's 84 of August. And as you can see, this one definitely paid off. So it's right around 10% a year, so let's call that 101. Alright, let's go to our next one. So again, we have this little spike here. And as you can see, these kind of, at least in this decade of the 70s, these kind of came sporadically, or not sporadically, they kind of came, one right after each other, kind of condensed. And this is kind of typical also as well as, in the early 2000s, when you had that early 2000s recession, we also saw some of these kind of condensed together. So we'll take a look at those as well once we get there. So September is 9, plus 3 is 12, plus 3 gets us to March of 75. So let's see where we at. So that one's 6 months, that's a 22% return, that is great. 09 dash, what is that, 75? Or 74? What is it? 74. So let's look at the 1 year. So September 75. So right around the same, call that 21%. Now let's look at the 5 year. That's 9. That's 57%. And then finally the 10 year, so 84 September. We'll call that 138%, not too shabby. Okay, and then our last reading of the decade, again, right, close to the other two, which isn't really a problem. Just got to make sure you got that capital. Always make sure you're adding to that account. So 2 plus 4 gets us to, what is that, March or April? So that's called 18%. That's a great return. 74. Let's look at our 1 year return. So October 75. So 24%, not too shabby. Look at the 5 year return. October 79. Got lucky on that one. No, let's call it 55%. And then finally the 10 year return. So October of 84. This one's gonna be good. 147%. Okay, so that's the 70s for you. We got 6 readings. And let's go ahead. Let's make sure that was all of them. So let's go ahead and stop there, and let's average these out. So So going down here, this really is, a pretty decent return. And again, not adjusted for dividends. If all you did was just simply buy once the RSI went out of the oversold for the decade of the 70s, your average 6-month return would be 9%. Your average 1-year return would be 21%. Your average 5-year return would be 28%, and your average 10-year return would be 87%. And that 10-year return is, more or less to that 9% return that we see, average annual return in the S&P 500. So it's very close to what you would expect, but the real parity comes in at this 1-year return. That's much greater than that 9%. It's over double what the average investor kind of expects to return in a passive investing strategy. So if all you did was simply buy the S&P 500 after the RSI went out of the oversold level and sold 1 year later, you were doing much, much better than the average investor. So I'm going to stop this video here. That was the decade of the 70s, and then we'll move on to the 80s next. Thanks, everybody.